Have you ever wondered how companies recognize revenue from contracts with customers? This is where IFRS 15 comes into play. Welcome to the fascinating world of accounting standards, where IFRS 15 stands as a beacon of guidance. Short for International Financial Reporting Standard 15, it's a critical standard that provides rules on how to recognize revenue from contracts with customers. Imagine a map guiding you through a complex forest. That's IFRS 15 for revenue recognition. It's the compass that ensures companies worldwide navigate accurately, consistently, and transparently when it comes to their financial reporting. And why is this so crucial? Well, accurate revenue recognition is the backbone of financial reporting. It impacts a company's financial statements, which in turn influence investment decisions and the overall perception of a company's financial health. Now that you have a basic understanding of what IFRS 15 is, let's delve into its core principles. IFRS 15 operates on 5 main principles, each contributing to how revenue is recognized. These principles provide a framework for recognizing revenue from contracts with customers and are essential to understanding the application of IFRS 15. Let's start with the first principle, identifying the contract with a customer. This might seem straightforward, but it's a crucial step. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. In the context of IFRS 15, it's about identifying an agreement that provides goods or services to a customer in exchange for consideration. The second principle is identifying the performance obligations in the contract. A performance obligation is a promise to transfer a distinct good or service to the customer. For instance, if a company promises to deliver a product and provide maintenance services, these would be 2 separate performance obligations. Next up is determining the transaction price. This is the amount the entity expects to be entitled to in exchange for transferring promised goods or services to a customer. It might include fixed amounts, variable amounts, or both. The fourth principle involves allocating the transaction price to the performance obligations in the contract. This means dividing the total transaction price between the identified performance obligations based on their standalone selling prices. The standalone selling price is the price at which an entity would sell a promised good or service separately to a customer. The final principle is recognizing revenue when, or as, the entity satisfies a performance obligation. Revenue is recognized when a customer gains control of a good or service. This can occur over time or at a point in time depending on the nature of the good or service. So there you have it. The 5 core principles of IFRS 15. Identifying the contract, identifying the performance obligations, determining the transaction price, allocating the transaction price, and recognizing revenue. These principles serve as a roadmap for revenue recognition under IFRS 15. Understanding them is key to applying the standard correctly and effectively. IFRS 15 is a complex standard, but there are some key points to remember. One of the most significant aspects of IFRS 15 is that it applies to all contracts with customers, with the exception of those specifically outlined in other standards. This universal application provides a broad and comprehensive framework for revenue recognition, ensuring that all transactions are accounted for accurately and consistently. Another key point to note is the increased emphasis on informative and relevant disclosures. IFRS 15 requires companies to provide more detailed information about their revenue streams than previous standards, ultimately aiming to enhance transparency and accountability. This increased disclosure requirement allows stakeholders to gain a deeper understanding of a company's financial performance and the nature of its revenue streams. The primary goal of IFRS 15 is to establish principles that companies apply consistently in their financial reporting. By doing so, it provides a more robust and reliable framework for addressing revenue issues. This consistency is key to ensuring the comparability of financial statements across different entities and industries. It's also important to note that IFRS 15 is designed to enhance comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets. This standard helps level the playing field and ensures that all companies are held to the same high standard of financial reporting. Remember, IFRS 15 aims to provide a more robust framework for addressing revenue issues, enhance comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets. IFRS 15 is an essential standard in accounting that determines how and when companies recognize revenue. It's vital to understand this, as it forms the backbone of financial reporting, enhancing transparency and comparability. The benefits are clear. It offers a consistent approach, provides robust financial information, and contributes to a more comprehensive view of a company's financial health. Mastering IFRS 15 will not only help you in your accounting career, but will also provide a clearer picture of a company's financial health. So, keep learning and stay tuned for more accounting insights.